Assalamualaikum salamat so perkenalkan nam saya Ayu Novalinda Kelas menjame 23 ANMP 234111065 di sini saya ingin mempresentasikan commercial bank. A general bank is a financial institution engaged in collecting funds from the public in the form of savings and distributing them back in the form of loans or credit, as well as providing other banking services. In Law Number 10 of 1998 concerning banking, it is stated that a bank is a business entity that collects funds from the public in the form of savings and distributes them to the public in the form of credit and or other forms in order to improve the standard of living of the community. Regulated by the Financial Services Authority, OJK, and Bank Indonesia, BI, in Indonesia. In general, there are two tasks of banks, namely collecting funds from the public or called lending, and distributing funds to the public or also called lending. Functions of commercial banks. 1. Fund collector, accepts savings in the form of savings, time deposits and current accounts. 2. Fund distributor, provides credit or loans to the public and businesses. 3. Provision of foreign exchange and investment services. Types of general bank products. Savings. 1. Savings. 2. Tour. 3. Deposit. Credit or loan. 1. Consumer credit, for example, mortgage, vehicle credit. 2. Business credit, for example, business capital, investment. Other services. 1. Transfer funds. 2. Safe deposit box. 3. Foreign exchange and remittances. The role of commercial banks in the economy. Liquidity provider. Liquidity is the ability to meet short-term obligations. In the context of banks, liquidity means ensuring that the bank has sufficient funds to meet customer withdrawal needs at all times. Driving economic growth. Economic growth occurs when there is an increase in production and consumption capacity in an economy. Banks play an important role by providing financing to drive economic activity. For example, commercial banks are under strict supervision of the Financial Services Authority, OJK, and Bank Indonesia, BI. This regulation aims to ensure that banks operate with a prudent principle, maintain minimum capital, and manage credit and liquidity risks. This strict supervision reduces the risk of bank bankruptcy and maintains public trust.